Fiscal dominance, a 1930s Great Depression-like deflationary spiral followed by 40% annual inflation, and the end of the U.S. banking system as we know it. These are some of the shocking warnings from Professor Calomiris, the dean of the Center for Economics and a professor at Columbia Business School. And as we'll show here, we are very close to this fiscal dominance reality, if not already there. Fiscal dominance, a reality where skyrocketing deficits and debt crush the Federal Reserve's ability to control inflation, forcing policies that could eviscerate your savings, crash the banking system, and send prices skyrocketing. This is not hyperbole. These warnings were published by the Federal Reserve itself, authored by one of the most reputable living economists. I'm going to walk you through the paper's most shocking predictions line by line with charts that make it crystal clear. Stick around to the end where I'll present one of the most unbelievable charts you've ever seen, showing how we are likely already at this fiscal dominance reality. So let's get right into it. This paper was authored by Charles Calomiris, a dean at Columbia Business School, and the Federal Reserve published it. This was published in the fourth quarter of 2023. I have some sections highlighted so we don't have to read the whole thing, just the key points here. He says, under current policy and based on this report's assumptions, government debt relative to GDP is projected to reach 566% by 2097. The projected continuous rise of the debt to GDP ratio indicates that current policy is unsustainable. Jerome Powell himself has said this. We can see that debt has grown about 5 times faster than GDP, going back to the end of the gold standard. Interest expense has grown about 2.5 times faster than GDP. He says fiscal dominance, this is the definition here, refers to the possibility that the accumulation of government debt and continuing government deficits can produce increases in inflation that dominate central bank intentions to keep inflation low. This article begins by showing that the prospect of this occurring soon in the U.S. is no longer far-fetched. So remember, this is what's driving the debt. Medicare is outpacing revenue, tax receipts, by 7.8x. Social Security outpacing revenue by 2.3x. Interest outlays are outpacing revenue by 2.7 times. Now, military expenditures are actually growing less quickly than tax receipts. A lot of people think that this military expenditure is a big driver. Sure, the total outlays are a large number, but when you look at the growth rate going back to the end of the gold standard, military expenditures are actually growing slower than government revenue in the form of tax receipts. So he says, indeed, if global real interest rates, remember, this is the premium over inflation that a treasury yield will provide. If global real interest rates return tomorrow to their historical average of roughly 2%, the U.S. would likely experience an imminent, immediate fiscal dominance problem. So, we will show, here's the real yield over the 10-year treasury. This is the 10-year minus inflation. He wrote this paper, and the real yield was about 0.7. We are currently at 2%, 1.95% on the 10-year real yield. So by his definition, we are already in this reality. The essence of fiscal dominance is that the need for the government to fund its deficits on the margin with non-interest-bearing debt. The use of non-interest-bearing debt as a means of funding is also known as inflation taxation. Fiscal dominance leads governments to rely on inflation taxation by printing money, increasing the supply of non-interest-bearing government debt. So just as a reminder, interest-bearing government debt is $36 trillion. M2, some of this M2 money supply is interest-bearing, is $21.9 trillion. M0, the monetary base, but this is bank reserves plus currency, narrow money. That is $5.6 trillion. Now remember, bank reserves pay interest, as we went over in our last video. $5.6 trillion. So you really have to look at currency in circulation. This is really the only non-interest-bearing money in the modern day system. That is only $2.39 trillion. Because remember, bank reserves pay interest. Going back to the paper, inflation taxation has 2 components, expected and unexpected inflation taxation. So, as a reminder, here's the monetary base, gold, and CPI inflation, the consumer price index for inflation, going back to the end of the gold standard, we can see that monetary base and gold have grown at basically the same exact rate. Since the end of the gold standard, gold is up 8,000%. The monetary base is up 8,000%. Meanwhile, CPI, which is what they will report on the nightly news as inflation, is only 834%. This inflation tax base, which consists of all non-interest bearing government debt, typically this consists of currency and non-interest bearing bank reserves at the central bank. But remember, they changed this, and bank reserves actually do bear interest. So here is from the prior video we did on kind of the overnight dollar markets. And remember this green line, this is interest rate on reserve balances. In purple, we see the sum or the total of bank reserves, 3.2 trillion. And green, we can see is actually above the secured overnight funding rate. It's above the effective federal funds rate. Remember, the Fed has kept this interest on reserve balance, IORB, has kept it relatively high because, again, I think that they understand the risk to inflation to the upside. Inflation taxation occurs when the nominal value of outstanding government debt falls unexpectedly, thereby taxing government debt holders. This component is also limited by the ability of the government to surprise markets by creating unanticipated inflation. So here is the market value of US Treasury debt in log form. So remember, if you see this is accounting for exponentials. If you see an exponential looking trend, it's kind of even more noteworthy. 26.7 trillion in the market value of U.S. debt. But now let's take that market value of U.S. debt and divide it by CPI. Remember, CPI is the government's way of accounting for inflation. So what I want to show here is that when we have gotten unexpected inflation, as Calomiris points out, peaks where the bond market has not priced in the risk of inflation, you can see that the inflation-adjusted real return on U.S. Treasuries. Now, we established that the actual inflation is much higher, right? We established that, but just kind of going with government statistics here, you can see that spikes in inflation here cause a decline in the market value of U.S. debt, and that is what he is referring to. He says the existing amount of zero interest debt, the inflation taxable base, is currently limited to only currency, given the bank reserves bear interest. Given the small size of the currency outstanding, if the government wishes to fund large real deficits, that will be easier to do if the government eliminates the payment of interest on reserves. This policy change implies a major shock to the profit of the banking system. For that reason, it is quite possible that a fiscal dominance episode in the U.S. would result in not only the end of the policy of paying interest on reserves, IORB, but also a return to requiring banks to hold a large fraction of their deposit liabilities as zero interest reserves. So remember, the banks have a checking account with the Fed. And what he is talking about is those bank reserves. He is talking about currently we pay above the effective federal funds rate. And as we'll show later in the video, actually higher than U.S. Treasuries. The Fed is paying the banks to hold that capital in those checking accounts at the Fed. What he is talking about is because currency alone is such a small number of total money, you have to include bank reserves if you want to increase the base that you can tax, right? You got to grow the pie, and to grow the pie, you got to include bank reserves. He notes in Mexico during the 1970s and early 80s, inflation taxation of banks became increasingly relied on as government expenditures rose. Eventually, as fiscal problems mounted, the government expropriated first bank depositors and then bank equity holders by nationalizing the banks. Taxing banks with the inflation tax, credit controls, or other means which can have major adverse consequences for the efficient capital allocation and growth. He notes a bunch of papers that go into that if you would like to read. I will include this paper in the description. I will actually do it this time, not forget. Reserve requirement are a regulatory decision that is generally determined by regulators. So he is saying if you want to do this, cutting Social Security is difficult. Cutting Medicare is difficult. Those are mandated by Congress. This is just a regulatory decision that a regulator can make. It is the decision of the Federal Reserve Board whether to require reserves to be held against deposits and whether or not the Fed pays interest on those reserves. Second, because many people are unfamiliar with the concept of the inflation tax, especially in a society that has not lived under high inflation, they are not aware that they are actually paying it, which makes it very popular among politicians. So here's TLT. This is the long bond ETF, and the chart is adjusted for dividends because, of course, long bonds pay interest. And for this, in an ETF, in the form of dividends. So now this looks okay, going back to the early 2000s. But now let's take a look at TLT's performance. Excuse me, that will come up later. TLT's performance in gold terms. So TLT divided by gold shows that the long bond has been getting just absolutely crushed in real terms. And here, let's look at TLT using CPI. So even TLT, even using that CPI metric that we know is not accurate, going back to the prior slide we looked at with the monetary base growing the same amount that the gold price has, we know that CPI is not accurate. But even using CPI, TLT has had a negative return going back over 10, 11, 12 years, as we can see by taking TLT and dividing it by CPI. This would not only reduce bank profitability by ending reserve interest on reserves, would not only reduce bank profitability, but also reduce the real return earned on bank deposits to substantially below other rates of return on liquid assets, think real estate, stocks, that sort of thing, which potentially could spur a new era of financial disintermediation as consumers and firms seek alternatives to low interest paying bank deposits. This occurred in the US in the 1960s and 1970s as a result of high inflation and regulation, including zero interest payments on bank reserves and ceilings on the deposit interest rate. An alternative policy path, of course, with less inflation taxation, would be for the government to decide to reduce fiscal deficits and thereby avoid the need for rising inflation and adverse consequences for the banking system. This may be a hard policy to enact, however, given that the main contributors to future deficits are large Medicare and Social Security entitlement payments. Also, defense spending seems likely to increase. We went through this in the prior chart that we looked at, but here he mentions in this particular passage, what he says is that, a lot of people might think, oh, we'll just increase the tax, right? But what he says is that, accurately, is that this would have a reduction in the growth in income, which would offset any deficit reduction coming from projected increase in the ratio of taxes to income. And this is accurate, right? If we look at tax receipts as a share of GDP, it's basically gone straight sideways the past 70 or 80 years. And here I overlaid real GDP growth inverted. So as tax receipts as a share of revenue get up to 18, 19, 20%, we can see that real GDP declines. Because remember, this red line is inverted. So as the red line is going up, that means that real growth is going down. And so he accurately points out that you can't just increase taxes because that has a deleterious effect on growth itself, which funds GDP funds tax receipts overall. Historically, high inflation is produced by growth in the supply of money that reflects the pressure of fiscal dominance, right? Inflation is a monetary phenomenon, but as he accurately points out, every major inflation in world history is a fiscal phenomenon before it's a monetary phenomenon. If a country issues debt denominated in its own currency, which is true of the US, the fiscal dominance arithmetic requires only one of these equations that he lays out in this violation of one of these equations, which would cause inflation to rise. The total debt held by the public is limited by the present value of prospective future fiscal surpluses. At some point, as the government debt to GDP ratio rises sufficiently for a given real interest rate and rate of real growth of the economy, the real demand for government debt reaches a maximum. So, what this means is that the current size of interest bearing public debt is greater than GDP itself. This is historically high in the debt to GDP ratio, reached only once before during World War II. The deficit has been running and is projected to continue running at greater than 5% of GDP per year. This was quaint. Back in 2023, it was a quaint 5% per year. We'll take a look at a chart in a second. It is much, much higher than that now. CBO projections imply that the debt to GDP ratio will reach 200% by 2050. But that assumes that real interest rates, again, remember, inflation adjusted yields, will remain at their historical lows. If they rise even by a small amount, the implied debt growth scenario is much worse. So 200% debt to GDP by 2050, that was assuming the assumptions made on that are that real yields would remain at 50, 40, 60 basis points. We know they are 2% now, 200 basis points. And so we'll take a look at deficits here. So here's the fiscal deficit as a share of GDP, and we've inverted it. So as the line goes up, the deficit is getting worse. Green lines indicate a surplus. We can see that the deficit has been growing, going back decades, right? Going back many, many decades. And this is historic. Normally, deficits are only ran during times of high unemployment, as the blue line will show. Deficit increases as unemployment, usually during a recession, right? The government will run a large deficit to control, to try to stimulate out of the recession. Well, look at what has happened recently. The unemployment rate has just, or put another way, the fiscal deficit as a share of GDP has just completely disconnected from the unemployment rate. As we can see, the unemployment rate is near historic lows, but yet the fiscal deficit is rising, going back many, many years. This is not just the current administration, going back at least to the prior administration. Current debt to GDP is in the range historically associated with the fiscal dominance ceiling. He is saying that the fiscal dominance ceiling is already here. Marketable interest-bearing debt, 100% of GDP. As a country gets close to that ceiling, the interest rate that creditors demand will rise as they demand an inflation risk premium. Remember, this is what we were talking about before, in anticipation of the risk of hitting the ceiling. So they demand that real yield, a higher real yield, before you actually get to the ceiling. This means that the perceived risk of hitting the ceiling, once you're close to it, can become self-fulfilling. So here is an illustration that shows here's the real yield in white. Here is the 30-year mortgage minus the 10-year treasury. This is a concept George Robertson has pioneered that I think is incredibly interesting, because the 30-year mortgage, the spread over the 10-year, this is really what the risk-free rate is. And look at what it has been doing going back, again, decades, going back to the early 80s. This is when debt to GDP bottomed. Debt to GDP started to increase in 1983, and sure enough, the real risk-free rate has been rising. Now, it's important to note, even the 10-year real yield has broken out of a 40-year, 50-year downtrend. So even if you don't believe the concept George Robertson has laid out with the 30-year, 10-year spread, even just using the 10-year minus inflation, we are already at 1.95%. We are breaking out of a 40-year downtrend. This is saying the bond market is anticipating inflation and demanding a higher premium to buy the debt. A rise in global real interest rates could reverse their 3 decades of decline, which we just showed, which would make the current debt to GDP ratio very risky. It would actually increase it. What does a government do that goes above that fiscal dominance ceiling, or even gets too close to the ceiling to survive? It prints money, which you can imagine as using cash to pay for government bills rather than issuing new interest-bearing debt. He says the mechanics of how this would work is by Fed open market purchases of government debt. This is called deficit monetization or debt monetization. When the Fed buys government debt, the reason that is a useful thing to do is that it reduces the amount of outstanding, right, someone else holding interest-bearing government debt in the hands of the public. Interest-bearing government debt pays an interest rate that rises with inflation because bond yields go up as inflation goes up, 1-for-1. But cash or currency or reserves that pay zero interest pay no interest. Monetization would allow the Treasury to sell debt to the public, sell debt to the Fed that public bondholders are unwilling to finance. So I think we're already there, and I will show that here. So here is government debt held by the Fed as a percent of GDP. And we can see this going back all the way to 1970. This was historically about 4 to 5%. Well, now we are at 15%. Now here is the Fed balance sheet as a share of GDP, and we are at 23%. So I think that this is already starting to happen. We see the Fed is just buying more and more and more of our debt because the public, the bond market, is unwilling to do it. So I think we're already there is what that shows. There are two components, expected inflation and unexpected inflation. We talked about this before. The expected component of the inflation tax is limited by the real demand for zero interest government money. The unexpected component is limited only by the one-time gain that comes from surprising people with rising inflation, which reduces the value of existing government debt and brings down the debt to GDP ratio. It is also worth noting that the inflation surprise of the 60s and 70s entailed a very large capital gain from the unexpected inflation tax, detailed in How Real is the Federal Deficit. In recent months, the market value of U.S. Treasury securities has already taken a toll on bondholders, including banks, declining from 108% of GDP in 2020 to about 85% of GDP today, mainly as the result of inflation surprises since 2021. So for this one, we're going to go back to TLT. I'm going to go back to the nominal and CPI adjusted TLT, and I'm going to show you the KRE. This is the Regional Bank ETF Index. And look at what happened with the unexpected inflation. You might remember those regional banks that collapsed. This is offset by 54 weeks, this purple line. And as you can see, the correlation here is very tight. As the real value of TLT, the long bond, as the real value of that declines, sometime after that, about 50 weeks or so after that, you can see that KRE, which is the regional bank ETF, declines massively. And we can see that the regional bank failures of 2023, we can see that KRE decline there, and it corresponded to, a decline in the real value of government debt. The big question about fiscal dominance problems for the U.S., therefore, are how much can the government gain from surprising outstanding bondholders with fiscal dominance? It's got to be a surprise. What would be the tax base of the expected inflation tax, and how much would real demand for zero interest cash fall, thereby reducing the real tax base of the expected inflation tax as the result of an increase in expected inflation? This tells us how much inflation would be needed for the government to be able to fund the fiscal costs not funded by interest-bearing government debt. And he goes through, and this is the actual math. This is the actual equation that he goes through with his assumptions. And what he says is that for the first assumption, he says the implied rate of inflation that satisfies the above equation is 16%. And this is assuming that bank reserves pay zero interest. This is assuming that the Fed reverses decades-long policy of paying interest on reserves, IORB. If a zero interest rate reserve requirement and 40% of reserve requirement, which we also right now have a 0% reserve requirement, banks are not required by the Fed to hold any amount of reserves. Now, SLR dictates some holdings by statute, but the reserve requirement for banks still, it got cut to 0 in 2020. It is still 0. And if that is a binding constraint, he talks about that reserve requirement going up to 40%. Then reserve holdings rise to 7.2, which is 40% of the $18 trillion in commercial bank deposits observed in February 2023. The implied rate of inflation that satisfies this equation is about 8.1%, and it implies a large reduction from inflation that is possible by raising that inflation tax base by mandating that banks hold zero interest reserves. So basically, what this is talking about is you force the banks to hold non interest bearing money and then you debase the money. What if, in the face of a fiscal dominant shock, the Fed did not eliminate interest on reserves and paid the market interest rate on all reserves? Under this assumed demand function, the result would be a rate of inflation in excess of 41%. Past experience suggests that at high rates of inflation, the real demand for currency falls at a faster rate than the rate of inflation rises, and the revenue maximizing rate of inflation is typically in the range of 30 to 45%. So what he is saying is that if you are a government trying to use this strategy of inflation to debase the real value of the debt, the cap at which you can do that is between 30 and 45% annual inflation. If the fiscal dominant shock is a surprise to the market, the good news for government spenders is that a sudden and persistent inflation shock would reduce the nominal value of outstanding government debt, causing debt to GDP ratio to fall, which implies a one-time increase in the future capacity to issue interest-bearing debt, taking off pressure of the need to do the inflationary money creation going forward. So you bring down debt to GDP, which just gives you more room in the future. But it is also possible that the fiscal dominance fears could grip the market too soon rather than too late. An early rise in the inflation risk premium, the real yield, would raise real rates prior to hitting the fiscal dominance constraint. So he's saying the bond market would see this coming and they would raise that real yield, just as we've seen, up to 2%, which is also what Calomiris says is the threshold for fiscal dominance. This pre-fiscal dominance inflation risk premium would reduce the real value of existing debt, but also raise deficits through the higher interest on new debt and perhaps raise the debt to GDP by reducing GDP growth. So what he is saying is that this anticipation, like as we looked at here and the other chart, that 10-year real yield rising and breaking out of a 40, 50-year downtrend could have a negative impact on growth. Currently, if you look at our deficit of about $2 trillion, interest expense is about 48%, about half of our deficit. And what he is saying is that as this real yield, as the bond market sees this risk of fiscal dominance coming, the real yield will rise, dragging on growth, right? Because remember, the real rate of return is restrictive. The higher this real yield is, the more restrictive it is on growth for the economy through, in the form of GDP. And he is saying that this rise in real yield would be a self-fulfilling prophecy and also raise the amount of inflation tax needed to fund the deficit in the future. So not only is it kind of a self-fulfilling prophecy, as the bond market sees it coming, real yield goes up. As the real yield goes up, growth goes down, meaning you need even more inflation to fund the deficits. Not only that, but it's self-fulfilling in a way. And now he goes on to talk about FedWire and kind of bank reserves. He says, first, note that the rise in FedWire transfers reflects a big increase in the proportion of securities market transactions relative to goods and services related transactions. This goes to our silent depression concept, right? Real personal income divided by M2, which shows the real purchasing power of American wages, has been declining going back 20, 25 years. We can see that in white. Well, look at the velocity of money has also declined since then. And if we look at a way to gauge this term called financialization, you take the S&P 500 and divide it by the average hourly wage to see how many hours of work must the average person work in order to buy 1 unit of the S&P. Well, back in the 60s and 70s, this was, 10, 15, 20 hours of work at the average job to buy 1 share. Now it is 192. So we have turned our economy into this kind of hyper-financialized casino, as we can see here. He says, driven by that boom in securities transactions. By securities, he means financial assets, basically. Driven by the boom in securities transactions, the annual value of payments affected through FedWire, the primary U.S. payment system for banks, increased by about 50,000% between 1957 and 2007, from 1.3 trillion to $670 trillion. At the same time, the reserves held as deposits by banks at the Fed, the funds used to make those payments, actually fell by about 37% from 22 billion in 1957 to 14 billion in 2007. Banks need reserves even though they are not required to hold them. And the reason why is that reserves, these bank reserves we keep talking about, are uniquely useful to clear these Fed wire transactions. Think when JP Morgan needs to pay Wells Fargo millions of dollars, Fed wire is the way that they do that. That is the system they use. And bank reserves are what are used to settle those transactions. In the current regime, reserves earn interest that is typically above the interest paid on debt, paid on treasuries. So we are paying the banks, as we can see here, this is one scale, we are paying the banks 4.4% to hold their cash at the Fed. But meanwhile, the 1, 3, and 6 month treasuries are all well below that interest rate. Paying market or above market, as we just saw, rates of interest on reserves makes reserves close substitutes for treasuries. They differ only in their usefulness to execute payments, such as Fed wire transactions. Conclusions here. As the result of the high current U.S. government debt to GDP and continuing projected deficits, we face a possible dollar inflation uncertainty nightmare. Continuing deficits, if unchecked, eventually will lead to a fiscal dominance problem. Again, remember, this was written in the fourth quarter of 2023, about 1.5 to almost 2 years ago. A significant rise in long-run real interest rates. When he wrote this paper, they were 60 basis points. They are now 200 basis points, which is ironically the threshold. He noted, Calomiris, the author of this paper, noted a significant rise in those real interest rates also seems quite possible, given that the 3 decades of decline in those real yields are poorly understood and may reflect temporary demographic influences. Such an environment would hasten the triggering of a fiscal dominance problem, leading to a messy monetization in the U.S. with ramifications possible worldwide. So here is government interest payments on marketable debt in white, that is 1.11 trillion. Here in red is interest as a share of tax receipts. We can see that 23% of tax receipts are going just to interest. Your eyes might be going to the late 70s, early 80s here, where it was even higher. Well, the difference is that government debt to GDP was down in the 30%, 40% range, not 120%. So, some people will use this chart in isolation and go, look, it's really not that bad. It was higher in the late 70s. They are ignoring debt to GDP. Remember, Calomiris in this paper talks about the capacity. There is a limit of demand for marketable debt and for zero interest debt. Many things would seem likely to change in a fiscal dominance scenario to make that inflation taxable base larger to facilitate the funding of continuing deficits with less of a rise in inflation. Interest on reserves would likely be eliminated. Otherwise, monetization would do little to relax the constraint on the government. Inflation would rise potentially by a large amount if that is the only policy used to create inflation taxation. So now let's talk about the kind of how much money this actually makes up. And I'll show you that mind-blowing chart that I mentioned in the intro. Here we have the Bank of America stock, Wells Fargo stock, and Chase in red, different scales for each of them. 2008 was when the Fed started to pay interest on bank reserves. We can see that was like the bottom in the 2008 GFC. It was a massive, massive bailout for the banks. This might be infuriating, and I'm sorry about that. IORB, or the interest on reserve balances, is currently 4.4%. The reserve balances, as we looked at in a prior chart, are $3.2 trillion. What this ends up being, that 4.4% on $3.2 trillion, is $141 billion per year going to the banks. Because remember, the banks have their bank reserves at an account with the Fed. The Fed pays the IORB interest rate, 4.4%, which we established is above the rate of treasury yields. Now, how does the Fed do this? Well, they don't. I mean, they do, but this is the most kind of crazy thing that you'll ever see. So here is liabilities and capital. This is the earnings remittances due to the U.S. Treasury. Remember, the Fed is supposed to make a profit, and as we can see, going back all the way, a decade prior, the Fed would turn a profit. Well, what it would do is it would take those profits and transfer them to the U.S. Treasury. We can see that going back, again, kind of post 2008, you can see that red line above zero, meaning the Fed was making a profit. Well, look at what has been happening recently. We can see the Fed has been turning a massive, massive loss of $233 billion. Now, remember, this is, because partly due to interest on reserve balances, that number that we looked at prior here of $141 billion. The Fed cannot afford that, very simply. Then you add in the reverse repo, right, where the Fed is paying interest on those reverse repo balances, and you get a $233 billion loss by the Federal Reserve. This is the Federal Reserve's profit and loss. You can think of it, and 233 billion in losses. But it gets even better. This is actually accounted as a deferred asset. So it is not even technically accounted for as an actual loss. They, through fancy accounting, got to just write it off as an asset. This $233 billion loss, they have actually written off as an asset. So not only were the banks bailed out at the bottom of 2008, and we can see how lucrative IORB, interest on reserve balances, has been. Not only are we, the people, paying $141 billion per year in interest on reserve balances to the big banks, not only did it bail them out at the bottom of 2008, in October of 2008, but the way that the Fed is writing it off as an asset, despite the fact that they have suffered a cumulative $233 billion loss. Only in government, only at the Fed, could you think of some engineering to twist and turn and flip a $233 billion loss into an asset. So anyways, hopefully that video covered a lot of ground. I will link the Calomiris paper in the description. I would highly recommend everyone read it and then read it again. I've probably read it 6 or 7 times. I think it's incredibly important, given the state of how I laid out in many of my slides here. I think that we are already near that threshold, if not past that threshold. And so I think that this is very, very timely. I might do a follow-up if anyone has a concept that I touched on in this particular video that they didn't quite understand. I'd be more than happy to do like a follow-up video to this. I think it's a critical concept for people to understand. So I'd be more than happy to do that. Leave a comment. Let me know what you thought. If you have any questions about this fiscal dominance sort of question and whether or not we've reached that, any concepts I addressed in the video, be more than happy to. Anyways, hopefully that was helpful, and I will catch you in the next one.